Okay, so the basic business model. Okay, so what is happening is that this is your business. This is the merchandising business. It's buying inventory from some vendor. Okay, so uh, this vendor could be, we're going to see this kind of in the bottom here, but it's basically someone who's providing you with the inventory. Okay, so uh, if you're a large enough retailer, okay, uh, you're buying from the manufacturer directly. If you're like a little convenience store, you're going to be buying from a wholesaler. Okay, that's and we'll talk about why that is in a second. But basically, you have someone providing you with the inventory, who is your vendor. That's kind of the term for that. The inventory is going from the vendor to you. You're holding it as inventory. Okay, so on your balance sheet, this inventory, you're paying money for it, but it's not an expense yet. Okay, it's going to be an asset on your balance sheet. Now that inventory, at some point, you hope is going to get sold. Okay, so this inventory now is going to move to this buyer. Okay, and at this time, whatever you paid for this inventory, it's going to come out as an expense. Okay, so let's just do a very simple example. If we bought the widget for $1 and we sold it for $2, right? At least we can see we made a profit. We agree? Okay. So in this example, the revenue, this $2 is the revenue, right? We're going to call that sales revenue. But we need to match it against the cost of the inventory because this is not a pure profit, right? We had to buy that inventory in the first place. So at this time, this asset is going to be expensed, okay? And we're going to call it cost of goods sold. This is an expense account. So just like we had like prepaid insurance, right? It was an asset. Then it came out as what? How did we expense prepaid insurance? Insurance expense, right? So that asset, prepaid insurance, went down and it came out in the income statement as an expense called insurance expense. So it's the same thing here. We're going to have inventory on the balance sheet. At the time that that inventory is sold, it's going to get expensed as cost of goods sold. So our inventory balance will go down. We no longer have that item. And the income statement is going to have both this revenue and this cost of goods sold in the same place. Okay. So people, I think, just remember this. Say it with me even. Cost of goods sold is an expense. Say it. So is that a debit or a credit normal? Is all expenses are debit normal? Okay. So the wording of it, cost of goods sold, it's not obvious that it's an expense, but I'm hoping now that you said it, it's like somewhere lodged in your brain that it's an expense because I think a lot of students like are kind of like confused about that. Okay, so look, every sales transaction, we're going to get to this. Good question. Every sales transaction is going to have two journal entries. There's going to be one journal entry for the revenue, just to record that, and then another one to do this inventory to cost of goods sold. So there's going to be two separate journal entries for every one sales transaction. Yeah, so there's one journal entry here where you're paying cash for inventory, right? But this sales transaction is going to be two journal entries. Okay, so that's what I'm saying. Like when you are the customer, when your merchandising business is the customer, there's certain accounting you do, and then when you're selling, there's a different set of like accounting considerations. Okay, so look, uh, this is kind of the full value chain of, you can say, uh, businesses that are involved in the selling of goods. Okay, so there's some manufacturer that's making the item, so they're going to manufacture it. This inventory is going to get sold, let's say in the kind of most typical case, to a wholesaler. Okay, because why can you, let's say you own a little 7-Eleven convenience store and you have candy bars. Why can you not just go to whatever, Hershey's Corporation, be like, hey, I want to order 100 candy bars for my store? Why can't you do that? Yes, it's not a big enough purchase, right? They're not going to deal with you because you're buying too small of a quantity. Okay, so this wholesaler is an aggregator. Okay, they're making a very large purchase, large enough that the manufacturer is going to kind of deal with them, and then they're going to kind of act as a middle. They're like kind of an aggregator for all the smaller people that can't directly buy from the manufacturer. Okay, you can think this role is actually really important in society. Okay, let's say there's some riverfront land. Okay, who can typically afford to do that? Who can buy that land usually? Like, let's say there's this one house. Is it going to be expensive or cheap? If it's on like lakefront property, it's going to be expensive, right? So it's going to be not very accessible for most people, right? So there is a middle person called a developer who will be like, hey, actually, I think 50 people could buy 1/50th of this. So what I'm going to do is buy that land, build an apartment building or a condominium development, and those 50 people can then live on the lakefront, right? So this idea that smaller demand units can be aggregated by some middle person, it's actually a really important function in our economy. And there's a lot of businesses that do this type of thing. In the selling of goods, that's the role of the wholesaler. So the wholesaler will buy that inventory. They're going to then distribute it out to the retailer. Okay, so this is where us as consumers, that's where we interact. Okay, we're going to go to the store and buy stuff. Okay, so again, the inventory is bought from the wholesaler by the retailer, and then the inventory is then finally moved to the consumer. Okay, so at every point of this is, $1, it's sold for 2, and then they're gonna sell it for 3, and then we buy it for 4. Okay, so at each point there's gonna be a little profit that's made. Okay, and maybe the manufacturer, it cost them 50 cents to make the thing. So this is kind of the value chain, as we call it. Okay, and each person is providing a service because not only does the wholesaler aggregate the demand, they're also providing a very important transportation logistics service, right? They're getting those inventory items to your store. They're gonna typically have some distribution method, okay, to distribute all the inventory to all these little places. Okay, so each of these requires like an incentive to do so, and this is the profit incentive, right? Um, so each of them is going to take a little profit along the way, but they are providing some value, right? They're providing some economically useful service. Okay, so but it is possible that some retailers, Costco, Walmart, Target, these are like really large retailers where we as consumers shop, they can also buy a ton of items, right? So they actually put out this and they just buy directly from the manufacturer. Okay, so that's why they can sell it for cheaper too, because they're kind of this profit that's taken at this step, they're cutting out, okay, because they're buying enough quantity to get it at this $1 price instead of having to buy it for whatever, $3 from the wholesaler. Okay, so let's just make sure we're understanding. Let's do a little discussion here. Here's some questions. So the first one, think about some retailers that you interact with. So, think about we all know what these businesses are. So now just be clear in your head what that is. Think about if you know of a wholesaler. Okay, this is we don't, as consumers, uh, usually interact with wholesalers, but maybe you know. Okay, so discuss that, see if you can think of one. Um, if you are a retailer, what metrics do you care about? How do you know that your business is performing well? Okay, so think about that. And it's kind of related to this last one. Okay, so I'm giving you a very specific example. Your store has room for one banana at a time, and you're buying it for $1, okay, from your vendor. So, what are the different kind of business models uh, can this retailer kind of enact to make a profit? And there's two of them, okay? There's two levers that they can pull to make a profit, or like two strategies, I guess you can say. So see if you can come up with those. So why don't we take a couple minutes, you guys discuss amongst yourselves, and we'll discuss as a class. Okay, so what are some retailers? I heard the common ones: Walmart, Target, Best Buy, where you buy your groceries, so like Whole Foods or Trader Joe's. These are all examples of retail businesses. Okay, yeah, Home Depot. Okay, what about anyone know any wholesalers? Exactly, yeah, or like Cisco, they're another food distributor. So yeah, but a lot of these are like behind the scenes. You see this term B to B. What does that stand for? What do the B's stand for? Yeah. Okay, what is the other business model? B to C, right? Business to consumer, right? So these are usually business to business. So unless you're like a retailer, you probably like unless you have some retail, because I'm sure there's like large clothing distributors, like there's distributors for anything you can think of, electronics. Um, so yeah, but unless you're in that retail space, you're probably not going to know. Okay. Um, like construction supplies, there's like distributors, wholesalers for that. Um, Home Depot actually has a wing, HD Supply. That's like their wholesaler for construction related uh, goods. Okay, if you're a retailer, what metrics do you care about? What's the important thing? And let's just frame it with this banana. So if you're buying your inventory, your banana for $1, what do you care about? What's the most obvious one? Yeah, selling it for more than $1. So that's one of the levers. So your retail price. Okay, what's the other one? Any other ideas of how I can maximize my profit? Okay, yeah, that's if you can buy cheaper, but there's another one that's like a little more fundamental. It has to do with this idea you can only hold one banana in your inventory at a time. Exactly. Turnover. Okay, we call this inventory turnover. All retailers are limited in how much items they can store in inventory. So there are some, uh, let's say, luxury retailers that they're going to charge a higher price here, but they're going to sell less stuff. Okay, so they're trying to make higher gross margin. Okay, they're trying to buy at some price and sell at a price and make a big spread on that item, on that single item. There are some that are like velocity-based suppliers or like velocity-based retailers where they're gonna buy low and sell high, but they're gonna cut the price and just try to make the lower margin, but a bunch of times. Okay, they're gonna try to like if we priced our banana at $5, if we just sold one of them, we're gonna make a huge profit, right? We bought for $1, we sold for 5. But how many people are gonna buy a banana for $5? You're gonna have to like market it up and have like a really nice, people will. If you go to West LA or something, there's probably like people that are throwing money away on food. But the other models, you sell it for $1.50, there's gonna be way more people that are gonna buy it, right? So you'll be able to make, even though you're only making 50 cents per sale, if you can sell 10 times as many bananas, you're gonna make more profit, right? So these are the two kind of levers that these businesses can pull to make a profit. And you'll see different retailers have some combination of these two.